and a warm welcome to this week's edition of Wealth Quest. I'm Samantha in the fourth of a range of interviews with industry veterans. We're hosting Stephen Silcock, a fund manager at Investec Wealth, who will be sharing his grandfather's 10 investment rules. Now, Alistair Martin, who presided over the JSE as chairman and president, shared his 10 most important investment rules with his grandson Stephen. These he learned whilst being active in his own asset management company and watching the market for many years through booms and busts. Tonight we'll be looking at the first of the rules, and next week we'll be dealing with the balance of those rules. So joining me at the desk, our special guest for this evening, Stephen Silcock, fund manager at Investec Wealth. As per usual, Cobie Legrange, strategist at ClucasGray Investment Managers, and Roland, Rousseau, equity strategist from ABSA Capital. Welcome to you, Stephen.
Thanks very much, Sam.
So it's great to have you with us. I suppose you could provide a bit of context to tell us a little bit more about your grandfather. Sure. And interesting that working in financial markets skipped a generation, but the bug bit for you. Yeah. And of course, you're following in your grandfather's footsteps.
Yeah, well, thanks very much, and thank you for the opportunity to be on the show. My grandfather was what you could probably call a doyen of the industry, and he arrived in South Africa after World War II. He was a major and a lieutenant in the British Army, and he met my gran on a train in Burma, and decided after 3 weeks that he was going to come to South Africa and start a life here. And his father-in-law had a stockbroking firm, introduced him, and over 60 years he literally lived and breathed the JSE. He unfortunately died in 2008 at the ripe old age of 87, and was still in the office. In fact, in January of 87, he was still working. He used to get in there before the birds even started chirping, and I left at around 12 o'clock at age 87. And I was rummaging around in my drawers, and I saw some 10 investment rules that he had written, and I thought that I'd write it for our private clients. And since then, it's literally gone viral, and a hell of a lot of people are obviously interested in them. I don't think they're particularly groundbreaking, but it's got a common sense and appeal, which I think is probably worth sharing.
Yeah, and tried and tested rules, because as you say, 60 years in the market and surviving through all of that, making a success of it.
Yeah, exactly right. And he was involved in a number of companies. He was chairman and president of the JSE through, as you mentioned, a number of booms and busts. But he was just a very conservative man with, I think, an inordinate amount of wisdom, which he was lucky enough to share. So when I got back from London in 2000, I was fortunate enough to literally sit behind him. I didn't make a trade or speak to a client for 2 years. I'm not sure that he trusted me too much at that stage, but I learned from his 60 years of experience, and it was just a wonderful experience.
Mm-hmm. You know what the great thing here for me is that here there's 10 rules from somebody that was an ex-chairman for the JSE and was a founding member of an asset management stroke stockbroking business. Often when we see these rules, we get them from America or we get them from European investors, and often we look at those and we say, how do they apply here to South Africa? Here we've got a set of rules that somebody has gone and written down by watching the market over such an extended period of time and saying that these apply, I suppose, globally, but specifically here to South Africa, which absolutely is just fascinating to look through.
Yeah. Rule number 1, there we go, let's get into those handwritten rules. The price paid for a share should have nothing to do with the subsequent decision to hold or sell. So take us through what that means for us.
Yeah, this is, I think it's probably quite a controversial one, but you have to go back into my grandfather's shoes. So he was quite old school. He didn't take to computers. He had these big blue files, and he would open up the file with the client's name on each individual bespoke portfolio, and he'd literally cover up the price that he paid for the share with either a ruler or a piece of paper, and make his investment decisions not on the purchase price, but on the current price and the weighting in the portfolio, which is a very interesting way of looking at things. A lot of people, for instance, I suppose a good example is Naspers right now, and it's up around 50% since April. A lot of people would then be considering selling the share. He would be saying, is it probably going to go up another 50%? And basing the criteria on the individual investment decision and the weighting in the portfolio rather than on how much it's gone up.
Any thoughts on that, Roland? I mean, kind of...
Yeah, I think prices are noisy, and I think if you leave the price out of the equation, you tend to focus on the value or on the nuts and bolts of the company, and not this kind of fickle market mad kind of price that changes all the time. It reminds me actually of a similar kind of rule that I got from Mark Beckenstraat at Prudential. He actually said that analysts and fund managers should actually not read newspapers, not watch TV. They should just look at the company statement, the financials, and try and make a decision based on that, and not be distracted by economic updates and news and things like that, which is a similar kind of...
But I mean, it comes down to what are you buying? Do you understand what you're buying? Has it got a place in a portfolio? And at the end of the day, are you happy to own the stock, regardless of the price that you actually paid for the stock?
Yeah.
And I mean, that's sometimes a difficult thing to do, because you're covering up the price. And even though the share price is going down in value, it might just reinforce the fact that you might want to carry on owning that business.
Let's move on to the second rule. The second rule here, there are many reasons to sell a share. Taking a profit is not one of them. If the share remains a good investment, don't try to second guess when it will fall. This relates to timing, and also we're talking about profits once again.
Yeah. I think, and again, this is probably quite controversial, because you often hear clients and a number of people saying, it's gone up so much, shouldn't we take a bit off the table? And you hear that time and time again. I think, again, it comes back to portfolio management, the risk in the particular company, and the weighting in the portfolios, rather than how much it's gone up.
Can I ask you, because a lot of people, wise people, say that one should have a stop loss. In other words, if you buy a share and it goes down X%, you should just get out of it, because if you just hang on there for emotional reasons, the thing could halve and you're still holding the thing because you're just too emotionally attached to it. How would a stop loss, which is sort of, if it does go down, get out, kind of work with this kind of rule?
The question actually goes into the next rule, funny enough, which is the first loss is the best one. So I think in his with regards to his experience and his investment acumen, he's suggesting that you look for companies with exceptional management, good quality businesses that are going to stand the test of time. If a share then goes down, you could potentially buy some more. But if there's a factor in a share that you haven't particularly taken into consideration, then perhaps you need to look at getting out rather than either buying more or continuing to hold it.
It sounds like if you're going to a casino, if you win the first time you go into a casino, it's the worst thing that could happen to you, because you keep going to go back again, right?
You see, the one thing that we carry on discounting, a lot of people discount by looking at emerging markets, is that South Africa actually has some fantastic quality businesses here. And it's sentiment in the short term that drives these businesses either to dizzyingly kind of heights from a valuation perspective, or pushes them back to really deep value territory. And as a matter of fact, just to show you quickly how that actually looks, look at your screen at the moment. You'll see the correlation between price to earnings ratio and the real return you could actually be making from the market. And here these numbers go back to 1960. So in simplistic terms, if you bought the market of a price to earnings ratio of 7 to 9, the subsequent 5-year average real return that you would have made is probably in the order of about 10%. And again, this just again speaks to, you buy quality and you don't overpay for it, you're going to get some really decent returns out of this market. But the caveat here is not overpaying for it. It comes back to valuation.
Yeah, but what I do like is coming back to that rule one is also, the price is a backwards look. The price you paid for it is looking backwards. It's about looking into the future where the share is right now. Let's move on to, so we talked about admitting your mistakes, so learning from your mistakes, getting the ego out the way with that one. Rule 4, where there's a tip, there's a tap. Think about why the tipster is sharing the gem with you. Maybe he wants to offload. So talk to us about that.
So this, I think, actually particularly pertained to the markets of yesteryear, where the liquidity was more of a concern than it is today. And he often used to use the golf course analogy, where you're sitting after a round of golf and someone says, I've got the best share for you. And on the other side, he's trying to sell the share. I don't think it's as pertinent, perhaps, of all the 10 rules as it is today with regards to the liquidity, but it is certainly something to keep in mind whenever someone gives you the so-called gems.
Yeah, I mean, you go back to 1929 and you go look at the stock market crash in the United States. most of it was predominantly because people forgot to do valuation. So nobody cared about the underlying business value that they were buying. They were more concerned with trying to make money. And that's what a tip really is at the end of the day.
Yeah.
You know, if a tip was that important, then quite frankly, they'd push it out on cents and get everybody to share with it, so the stock price generally could be going up. But invariably, as you guys know, you continue to find people giving you tips in the market.
I remember, actually it wasn't my grandfather, but someone else in the industry telling me that that when the US taxi drivers start telling you which shares to buy, it's usually a very good time to get out the market.
I mean, as I always say, take it from whence it comes. But I suppose you could also maybe take this rule a little bit further and say, you know, when management is communicating with you certain messages,
Yeah, sure.
you know, understand why they're trying to tell a story in a certain way.
Yeah, I think outlook is very key, particularly at results time, and it's certainly some of the criteria that we use definitely today.
Well, Carl Icahn just bought $1 billion worth of Apple, but he told us after he bought it, not before he bought it, right? So.
And that tweet is probably now one of the most famous tweets going around. Rule 5, be aware of averaging downwards. Be wary of buying more of a share unless it is on behalf of an initial buyer. To use the equivalent military maxim your grandfather said, never reinforce failure.
Yeah. Again, I think that a lot of private clients and men on the street make this mistake. And I suppose a very good example is Anglo Platinum, which was trading at well over 1,000 in 2007, 2008. We obviously had the GFC, the global financial crisis, which impacted all resource shares in particular and the market as a whole. But if you had averaged down from 1,300 to what is now 400 after quite a subsequent, after quite a heady bounce, you would have been seriously out of the money. So I think each and every single share needs to be taken into context, not only in its sector, but with regards to the market as a whole.
Mm-hmm.
I think the big thing here for me, and I think this is the interesting, this one rule for me stands out as a very interesting rule, because if we go back to the day of the stockbroker in South Africa. So there was no analogy between asset manager and stockbroker. Alistair Martin was a man that actually had a strategy. He said, listen, if we're going to build a portfolio, then this should be on the back end of a strategy. So he's asking the question, every time I add a stock or every time I buy subsequently to having bought a share, is this as part of a strategy for a client or is it not?
Yeah.
And I think that becomes really, really important. And he was believing this at a time when most people were jockeying stock. And people were saying, buy this and sell that, and buy this and sell that. And often, skimming huge commissions off markets. And here a man saying, have a strategy. That's more important to me. And I think he can be commended for that.